Tesla stock is trading live right now at $384.08, marking an intraday drop of 3.18% on significant volume as the broader market wrestles with shifting capital flows and severe macroeconomic pressure ahead of tomorrow's inflation data. While the common narrative surrounding this slide blames general electric vehicle fatigue and near-term margin compression, the real story playing out behind the scenes involves an institutional asset rebalancing of massive proportions. Wall Street is currently preparing for the historic NASDAQ listing of SpaceX, set for just 2 days from now on June 12th, and large funds are actively treating Tesla stock as a liquid funding vehicle to clean up cash for the massive initial public offering. This creates a fascinating structural pressure where the underlying enterprise is actually fundamentally healthier than it was during its late 2025 struggles, yet technical selling is driving the price down through its near-term support lines. The expectation among retail traders using popular platforms like the Robinhood app or engaging in online investing via standard individual brokerage accounts is that a major analyst upgrade should automatically trigger a sustained bull run. Just days ago, JP Morgan completely abandoned its decade-long bear thesis on the company, delivering a massive upgrade from underweight to neutral and raising its price target by over 200% to $475 per share. Under normal conditions, that kind of institutional pivot would send a growth stock soaring, but the reality is that the market is refusing to chase the headline. Instead, the trading volume on online investing sites and sophisticated institutional networks like interactive brokers trading platforms shows that big money is hyper-focused on the fact that the company has guided for negative free cash flow for the remainder of 2026 due to an aggressive $25 billion capital expenditure plan dedicated to artificial intelligence compute and autonomous fleet infrastructure. This sets up a classic conflict between narrative expectation and operational reality. If you open up your portfolio tracking tools on the Fidelity mobile app or look at your customized screens on Schwab Intelligent Portfolios, you see a stock that peaked near $480 in late 2025, plummeted to $335 in April of this year, and is now getting stuck in a dense moving average cluster between $395 and $403. The market wants immediate gratification from the full self-driving subscription revenue, but the financial statements show that the company is currently sacrificing its cash cushion to build out massive data centers. This massive investment cycle is creating a deep rift on Wall Street. On one side, you have the newly converted bulls at JP Morgan, who argue that the company's value is now entirely uncoupled from short-term car sales and anchored directly to robotics. On the other side, analysts at Barclays are keeping a hold rating with a conservative $360 target, claiming that real-world deployment of autonomous vehicle fleets in testing cities like Austin is moving far too slowly to protect the stock from its current high valuation multiples. To understand why this intraday slide to $384.08 is catching so many self-investing individuals off guard, look at the underlying trading mechanics. High-frequency trading algorithms have been hammering the classic pivot points all morning. When the stock opened at $391.54 and briefly touched an intraday high of $397.09, it ran directly into a wall of institutional supply. The 4-hour 50-period moving average sitting right around $392.73 and the 200-period moving average at $420.94 are both sloping downward, acting as heavy overhead resistance. When a stock cannot reclaim its short-term moving averages even after a blockbuster Wall Street upgrade, it tells you that the collective market is demanding realized earnings rather than future promises. Retail investors who trade Robinhood fractional shares or buy into thematic Fidelity ETFs are trying to support the floor, but the sheer volume of institutional liquidation is dominating the tape. Comment below how many shares of Tesla stock you currently hold and whether you are buying this dip or waiting for a lower entry point. When we strip away the daily noise and examine what the company actually does, the structural shift in its business model becomes clear. Historically known simply as an electric car manufacturer, the firm is fundamentally changing into a vertically integrated hardware and software conglomerate. Its core business still relies on designing, manufacturing, and leasing premium electric vehicles, alongside energy storage products like solar panels and large-scale commercial batteries. However, its high-margin revenue streams are increasingly coming from services, network insurance, supercharger network monetization, and premium software features. In the first quarter of 2026, the company reported revenue of $22.39 billion, which represented a healthy 16% increase year over year. More importantly, gross margins climbed back up to 21.1%, a significant recovery from the mid-teen lows seen during the height of the global electric vehicle price wars last year. This margin expansion was largely driven by lower battery material costs and a richer mix of recurring software subscriptions. Despite these improving fundamentals, the reality of the balance sheet is what keeps professional wealth management teams cautious. The company's recent regulatory filings confirm that while operating cash flow reached nearly $4 billion, the absolute insistence on spending $25 billion on capital expenditures this year means free cash flow is going to remain heavily constrained. For an investor looking at long-term compounding, this capital allocation is exactly what you want to see if you believe in the autonomy thesis. But for shorter-term managers who benchmark their performance quarterly, negative free cash flow makes the stock incredibly vulnerable to macro shocks. If tomorrow's consumer price index data comes in hotter than anticipated, implying that interest rates will stay higher for longer, long-duration assets that defer their main cash generation into the future will get hit the hardest. That is the exact tension keeping the stock pinned below its key moving averages today. The upcoming SpaceX IPO adds a completely unprecedented layer of complexity to this narrative. The space logistics company is coming to market at a fixed price of $135 per share, aiming for a stunning $1.77 trillion valuation. Because the target valuation actually sits above the current market capitalization of the electric vehicle business, a massive debate is raging across online investing forums and institutional trading desks. Some portfolio managers fear that retail investors who traditionally allocated all their speculative capital to a single automotive ticker will now split their attention and their wallets, leading to capital flight. Conversely, the reality is that the automotive business is the beneficial owner of nearly 19 million Class A shares of SpaceX, a position currently valued over $2 billion. This means that as the space enterprise scales in the public markets, it directly boosts the asset value on the automotive firm's balance sheet, creating a hidden valuation cushion that many casual traders completely overlook when managing their accounts through basic investing sites. Looking ahead, the tension between what the market expects and what the operational reality presents will likely be decided by three distinct catalysts over the next 2 quarters. First, the official public trading debut of the space sister company will establish a concrete market price for the parent firm's equity stake, which could force a repricing of the stock. Second, the upcoming second quarter earnings report, expected in late July, will give the street its first look at whether the 21% gross margin achieved in the first quarter was a temporary blip or a sustainable structural floor. If margins continue to trend upward despite flat overall delivery volumes, it will prove that the services and software mix shift is working. Finally, any concrete data regarding the true scale and deployment speed of the autonomous ride-hailing network will either validate the massive capital expenditure program or confirm the bear case that the technology is taking too long to scale commercially. For individual investors utilizing a Robinhood cash management account, managing an individual brokerage profile, or navigating the markets via specialized tools like interactive brokers platform setups, the current price action demands a disciplined framework. The technical chart shows near-term support sitting right around the $380 level, which represents the lower boundary of the prior trading range. A clean daily close below $380 would open up the door for a deeper retest of the April lows near $335, especially if macroeconomic data turns hostile. On the upside, the stock needs to print a daily close above the classic pivot point at $422.66 to signal that institutional distribution has ended and that buyers are firmly back in control. Until that alignment happens across the moving average family, the price action is likely to remain highly volatile and fragmented. In summary, the deep contrast between market expectations and raw reality is what makes analyzing this asset so compelling. The public narrative remains caught up in sensational headlines about executive focus, analyst price target upgrades, and speculative merger rumors. The reality, clearly visible in the intraday drop to $384.08, is that the stock is trapped in a multi-month technical consolidation, burdened by an immense capital expenditure cycle and near-term capital rebalancing ahead of a major ecosystem liquidity event. The underlying business has successfully stabilized its automotive margins and is successfully growing its high-margin services segment, but the market is refusing to pay up front for an autonomous future until the cash flow statements reflect realized returns. Navigating this landscape requires looking past the daily momentum swings, monitoring institutional volume trends across elite trading platforms, and maintaining a strict focus on structural support levels as the broader macroeconomic story unfolds.